Have you ever wondered what wealthy investors do when the market is unpredictable and shaky, when maybe interest rates remain high, inflation is creeping up, and you just don't know where the market's going? Now, unfortunately, this has happened repeated times in history, and there is a plan that wealthy investors follow, and I want to share that with you today. Now, if you and I haven't met before, again, my name is Whitney Elkins-Hutten. Welcome to the Passive Investing Made Simple show. You're in the right place if you want to learn how to take your active income and turn it into long-term passive income and wealth. Maybe you've tried investing in a passive deal before and just couldn't get comfortable making the investment, or you're actually invested in a deal and realize, oops, it does not align with my goals. I need to figure out how to do this better. Or maybe you're a seasoned investor and you just want to level up your skills. If that's you, you're in the right place. Again, this is the whole reason why I invest passively in real estate. Now, I've been investing actively and passively in real estate since 2002. I do this so I can spend more time with my crazy crew that's pictured here. We love traveling, hiking, doing anything outdoors and in nature and spending time together. And my real estate portfolio has allowed me to do that. I initially started scaling, taking my active income and investing in active assets and scaled an incredible amount of wealth that way. And then I realized, wait a second, I don't have control and choice on how I spend my time. And that's where passive investments really entered the picture for me. And I've documented that journey that I have followed in my book, Money for Tomorrow, How to Build and Protect Generational Wealth. You can snag that on Bigger Pockets or Amazon. But moreover, everything, all those numbers that you saw there on the previous screen were, to help me get one result in my life, which is how do I get control and choice on how I spend my time? Now, we can help you do that here at passiveinvesting.com, whether it's through our equity investments, such as multifamily, self-storage, express car washes, or in our passive investments in our real estate debt fund. Now, just to clean that up, everything is a passive investment there. Some are more equity driven, others are more cash flow driven, but we can help you achieve those goals. And so if you want to learn more, want to connect with me, want to see our open investments, be sure to scan that QR code that you see on your screen or visit passiveinvestingwithwhitney.com. Now, we opened up today's conversation talking about how do investors invest in the market? How do wealthy investors actually look at shaky markets, the volatility, uncertainty in the markets, and really know what to do? Okay, do they have some sort of crystal ball that we don't? Now, I'm going to go over through a framework here today, some tips that I've learned along the way in my investing career, but everything that we cover today is education. So it's not legal advice, tax advice, financial advice, so make sure you take this back to your investing team before making an investment decision. Okay. Now, I'm going to break this down into 6 different areas. We're going to cover what happens, what not to do when markets get shaky. We're going to look at our 3-tiered fortress investing model. I love hammering this home with our investors because it's such an amazing way to create a balanced portfolio. We're going to look at the timeline risk and how to stay invested wisely across different market cycles. We're going to take a look at some real world examples, what's working right now, and how you can apply this to your own investing strategy. Now, let's kick it off. Where do most investors go wrong when there is a market uncertainty? Okay, well, to start it off, the question is the uncertainty real or fabricated? And there's always some sort of truth in headlines, but we have to understand that headlines, media thrives on drama. They thrive on clicks. Okay, so we have to actually look at various headlines that we're seeing about market volatility, market cycles, what is happening, what could happen, and really look beyond the drama to actually find the truth. And sometimes that's easier said than done. Even webinars, free content that you see on YouTube, Instagram videos, all of that is meant to hook your attention. That algorithm rewards any content producer to create a hook to capture your eye as the investor, as the content consumer. So we have to make sure that we're looking beyond the hook, that distortion that's created with these headlines. Okay, so that's, sometimes investors, are making decisions based on bad data that they see in the headlines. Okay, then we have to understand that market timing rarely works. The investors I've worked with that have tried to time the markets, every market cycle perfectly so they can either capture the greatest amount of equity upside, that rarely works. We don't really know when we've hit the bottom of a market until probably 6 to 9 months later. And then we can go, oh, yeah, hey, that was the bottom. We should have bought that property like 6 to 9 months ago. Okay. If we did hit, capture that equity position at the bottom of the market, it probably was an education influence decision, but moreover, it's the investor who is learning to invest in every part of the market cycle that is being rewarded. All right. Fear can equal inaction. That's another area where investors go wrong. So it can also mean when people are fearful that they're chasing the wrong outcome. So this can show up in paralysis by analysis, desperate reach for yield during a time when yield really isn't present, and people get invested in all the wrong deals, okay, that don't match their goals. They're taking, as we've covered, a couple of sessions ago, they're taking undue risk for the risk capacity that they actually have. Okay. Now, also, investors in shaky markets tend to go like it's like they're betting on at the casino. They tend to go all in or they stay all out on the sidelines. Okay. There's no room for some of these investors to adapt their investor thesis and their strategy as the market begins to move. Now, I will raise my hand as somebody who did this in the 2008 financial crisis. I had no idea. I was, fairly early on in my investing career. I sat largely on the sideline watching all of this, carnage happen in the stock markets where had I just continued to take the small bets on myself and my flipping real estate, which I was doing a little bit of, but not as much as I probably should have, I probably would have created some life-changing wealth for myself. Okay, so we're going to help you fix that today. How can we bust through the headlines, the timing fear, just the fear in general, and this compulsion to either go all in on investing or stay out on the sidelines? All right. So the first thing we have to understand, okay, now that we kind of understand what are the big things that tend to get in an investor's way, what is a framework that we can look at and follow? Now, I've put this in front of you, our investor, several different ways, but I've always called it the three-tier fortress investing framework. All right. Now, there's really 4 tiers here. There's 3 that I talk about regularly, but somebody called me out and said, hey, Whitney, I know you do Bitcoin. I know you do other investments. Where do those fall in your investing framework? And I wanted to let you know that here. Okay. So the first tier is making sure that we got that tier 1, that fortress layer, that boundary layer that provides the safety and liquidity, reserves, money market, T-bills. Okay, then we have that layer that provides the income and optionality. Okay, this is where I love real estate debt funds, notes, promissory notes, personally owned real estate, if bought in a certain way, can possibly fit in here. Otherwise, I push that up to the growth piece. Then tier 3 is growth. Okay, now tier 1, all investors, we need to have our safety and liquidity and reserves in place, okay, before we start scaling. And then it really depends on where you're at in your timing. Are you going to go after the income and optionality first, or are you going to go after growth? Right now is an amazing time for investors to continue to build out the income portion of their portfolio and then capture the growth as markets stabilize. We still have that volatility here. Now, to touch on tier 4, okay, I actually don't call the tier 4 really investing. These are more like hedges. Okay, it's kind of like pushing your chips in and going all black at the roulette table. Okay, I've never played roulette before, so hopefully I got that analogy correct. But this is going to be like your cryptocurrencies, like Bitcoin, going in on huge opportunity zone fund deals, startups. Okay, Can they yield a return? Yes. Can we mitigate the outcome as much as we want to? Probably not. Okay, we have less and less control of what actually happens when we place money in this tier. So I put that up at the top, especially so if it were a pyramid, it'd be the tippy top and probably the last thing that I'd ever go into. Okay. A well-designed portfolio helps us balance out this tier, helps us take advantage of timeline risk, reduce our risk tolerance and risk capacity risk. And here's the thing, most investors are probably, if you evaluated your portfolio and listed out every single one of your assets and assigned them a tier, I would imagine you would find that you're overly weighted in a tier 3 investing, maybe even tier 4. Okay, so we need to make sure that we are not underprotected in that tier 1, tier 2. But that's just one way wealthy investors really help stabilize their portfolio in shaky markets. Okay, really, what wealthy investors try to do is not do this. Okay, they're not going to be in a shaky market. They're not going to be 70 to 90% in equity. They will have liquidated a large portion of their equity positions to go into liquidity and optionality type tiers. Okay, now they're not betting on appreciation right now. Okay, if they can get a little bit, continue investing a little bit into some growth, but largely into the income, they're going to capture some of that upside as the market recovers. However, they're going to look like geniuses because they went in on a deal whenever it hit the bottom. But the thing is that they were continuing to place bets in all of these different tiers. Okay. Again, they're not going to be like the normal investor that has very little liquidity or income, and they're going to have a plan when the market shifts. Okay, if you're following what Warren Buffett's doing right now, he is sitting on a lot of assets that he can liquidate in a heartbeat to start investing in growth assets as soon as they start recovering. Okay, so he is prepped for the bull market. He is prepped to buy when other people might still be sitting on the sidelines. So let's talk about this from kind of a mentality, like an emotional response to shaky markets. When markets become uncertain, people do one of three things. They either freeze, okay, they become very paralyzed by what they were reading in the headline and they do nothing. So you're going to miss out on all opportunities, growth, income, liquidity, stability, okay? They're going to fight. Okay, meaning they're going to swing for the fences and try to be like, okay, blood in the street, let's start investing in all these different areas that we possibly can. Okay, they might be jumping into assets with dangerous returns, or they're going to stay in an equity deal too long. Okay, they're going to fawn. They're going to stay in these toxic deals for far too long, trying to hold on, and it can be like quicksand. But here, uncertainty does not mean, when a market hits uncertain, doesn't mean do nothing. It means reassessing your portfolio and reallocating and getting it in position to grow. All right, so just to recap, what should your fortress portfolio look like? Again, this is just one way to invest. This is not investment advice, okay? But if you're in a shaky market and you're poising your portfolio to be able to take advantage of growth, this is what I moved into recently, is looking at my portfolio and getting somewhere between 30 to 50% in assets that protect my wealth, create liquidity, create income right now. Okay, now I'm allowing that income to continue to compound. So I'm getting equity like growth, but taking a very low risk position. Okay, then I'm, continuing to, shift my upper, part of my portfolio, my growth portfolio, probably closer for me. Like, I believe it or not, I'm closer to retirement than I am to my accumulation phase. Anyways, I'm probably like up to like 30% in like growth. All right. Now, this is very different than some investors that I've seen. Their portfolios are 70, 90% growth and like 10 to 20% liquidity and income. All right. And then tier 4, those wild cards, those hedges, I really like keeping all of that to less than 5% of my portfolio. I consider it like fun money. If I win big, awesome. Would losing 3 to 5% of my portfolio devastate me? No. All right. So, for some people, they may edge up closer to the 10%, but if we're going over 10%, we need to take a look at what kind of investor are we? All right. Are we taking on too much risk, for the capacity that we have? All right. So again, when markets get shaky, when the things are unknown, okay, we need to look at that liquidity and optionality part of our portfolio. Okay. Liquidity should not equal cash drag. If anything, it actually we should have cash above and beyond what we need for reserves invested. It should be performing. Okay. Depending on your risk tolerance, investment might look like money markets. Okay, where you're just barely matching inflation, but you're not losing to it. Or you can be upwards into like my preferred investments, which is like, short-term real estate debt funds. Okay, that's what I really like. Okay, it's almost like having dry powder on the sideline. Making sure you build out this part of your portfolio, the liquidity and optionality, can help you move quickly when opportunity arises. And it can actually give you power because now you have choices. You have the ultimate competitive advantage as an investor. You can sit there and wait for the perfect opportunity because why? You're getting cash flow, right? You're beating 2x, 3x, or more inflation. You're getting the cash flow. Through compounding, you're getting even more growth, equity-like returns. Okay, now, are we getting the 20% IRR? Probably not, but okay, we're at least matching what we could be getting into, just your regular stocks, bonds, and mutual funds. Yeah, but more important, it gives you that power, that optionality to go into an investment by choice. Okay. Wealthy investors, they don't let their cash sit idle. They are putting it to use. Okay. So let's kind of put a pretty bow on what we've talked about today. Again, we're learning to, when the market is shaky, questionable, okay? We don't know if it's going up or down, which direction it's going to go, okay? We can still invest, okay? We can do so defensively by making sure we got at least 30, maybe depending where you are in your investment timeline, closer to 50% in that tier 1, tier 2 type of investments. We're going to make sure we're not overly concentrated in equity. Okay, we're going to diversify across our risk levels, not just asset types. We're going to leverage compounding to help us grow so we can be patient as those equity deals come on board. All right, and then we're going to focus on liquidity, not just yield. Okay, so we're not chasing, even in this liquidity layer, we're not chasing the highest return we can get with a debt fund. Why? We might be taking on equity-like risk if we do that. Okay, we're going to focus on getting cash flow, but also reinvesting it and compounding it, but maintaining that liquid position. Okay, and then, when we build out this liquidity and income, arm of our portfolio, now we can start deploying capital into multiple timeline and market cycles and as the equity markets move. Okay, so we're not just an one timeline risk. You're not all in 2021 vintage multifamily assets. Okay, you can start investing in assets in all different parts of the growth and supply curves. It's kind of like dollar cost averaging in stocks. All right. All right. This allows you to shift into those assets that have the most likelihood of performing as opposed to investing and hoping it performs. Okay. We're mitigating that risk across cycles, across timelines, and you get to look at invest in assets with the best likelihood of performance across those timelines. Now, somebody might be listening to this and say, Whitney, great information. Don't really know how this is put into use. Show me how what you're saying, making sure to build a portfolio that can move through markets. How would this actually look? Well, in 2008, 2010, if you were sitting in cash, you were waiting for the debt and discounted equity plays to come online. Okay, 2016 or 2012 to 16, the market conditions were recovery, low interest rates. You were probably waiting for those value add deals, sitting in cash, waiting for those value add deals and syndications to come out and play. In 2020 and 2021, right after the COVID lockdowns, okay, capital was super cheap. Okay, optimism was high with our rebound. Okay, so you were probably looking at strategies that provided a little bit higher growth and refinancing options to them. Today, okay, we've got volatility, we have interest rate pressures. It's September 26th. I know all of us are like waiting in bated breath for the Fed to hopefully lower interest rates. Will they? Doesn't matter. Okay, you are learning how to invest in every part of the market cycle. Okay, so what is the market giving us today? What are the wealthy investing in right now? And that's income first, debt funds, and liquidity assets. Okay, smart investors, they don't chase returns. They look at what the market and the credit cycles are giving them, and they put their capital there, making sure to protect it and keep it liquid. So my question to you is, what part of the cycle do you think we're in right now, and how should your strategy change? Okay. Are you in mostly tier one assets, tier two, tier three? If you're here live, go to the chat box. I want to know. Okay. And where does your portfolio need to shift? What tier do you need to build? Okay. Now, an investor last time challenged me, hey, show me the money. Okay. If I take my cash off the sidelines, show me what I could be doing with that. Well, here's a real world example. If you have $200,000 sitting in the bank, and let's just say, and not even the bank, say in the money market, I looked up VMFXX, which is the Vanguard total money market. Right now, okay, last week it was returning a 4% yield. So that means you're earning $667 a month in yield. Okay. Now, inflation, is clocking right now at 2.9%. So you're either getting a little bit, most people are putting inflation, most economists are putting inflation probably closer to 4 just because of how things are calculated. Okay. This means you're just basically getting even, if not, being eroded a little bit. So you don't have any real strategic optionality here. But using debt funds wisely, building out that tier one, tier two layer, that same $200,000 can generate $1,333 a month, maintain your capital access, and put you in a position to be ready and patient and ready, I should say, for those growth assets. Okay, so again, one of my favorite investments is our real estate debt fund model. If you want to learn more, reach out to me. But I more want to tell you why I love debt funds right now, especially first position lien debt funds in residential real estate. It's because you got the low monthly income, low volatility. You can spread the risk across multiple markets, multiple borrowers, multiple loans, and you can earn 6 to 10% and then allow it to compound. Okay. So if you're looking for this type of tier, make sure to reach out to me. Okay. But I want to leave you with some next steps. What should we do next? Well, one, you got to map out, where are you in your investment cycle? Okay. Where are you with building your investment fortress? Okay. Are you in, where are you heavily weighted in that 4-tier model? Okay. Okay, map out your current allocations. Identify where you're overexposed, underprotected, and then rebalance. Okay, this is a great time. If you don't have that tier one, tier two built out, great time to build that out for sure. All right, if you want to learn how to unlock your investing potential, make sure to reach out to me at passiveinvestingwithwhitney.com. There we can jump on a one-on-one call and I can help you meet your investing goals and provide you some additional resources and education. All right, if you're here live, don't go anywhere. We're about to start the Ask Me Anything part of your show. Ooh, I have an investor here that actually answered my challenge question. What tier are you in? What tier do you need to build out? Somebody here says, I'm primarily split between tier one and tier two, but I'm a little heavier in tier one. Okay, great. So my question then to you is, what do you need? Are you, how much are you losing to inflation right now? Losing to market conditions? And are you able to remain patient? That's the other thing about utilizing something like debt funds to invest is that if you're getting cash flow and you're able to compound it, you can see that you're getting month over month, quarter over quarter, year after year growth. It allows you to be patient. Okay. Right? You don't feel pressed to go anxious for the money sitting in the bank going, I have to go into an equity deal. I have to get the tax benefits. Okay. Of course, we want to, build out our portfolio in order to, slide in some more of those growth investments, depending on where you are in your investment phase. But yeah, just pay attention. Make sure you're not over allocated into that tier one. Okay, we want to keep 6 to 12 months worth of reserves there. That's my happy spot is closer to 12. My husband's happier spot's closer to 3. So we land somewhere between like, probably closer to 9 months worth of reserves. But we are quickly deploying anything above that, beyond that into like that tier two. What questions do you have? What did you love? What would you love to see? I want you to go over to the chat box and drop that in as well. Somebody says, I thought this would be more exciting. Well, that is a great comment because if it were going to be, I don't know. My take on passive investing is 90% of my investing is boring. I don't want my investments keeping me up at night. I want to know that they are performing, that, I've done what I can to, mitigate, the risk in that portfolio. I'm still going to be subject to market risk and what happens there. I do understand that as an investor. But past that, I want it to be pretty boring. I'm not like swinging for the fences. If I had to equate it to baseball, it would be, uh, you know, if I hitting mostly base hits, maybe a double every now and then, and the off chance, like every few years, I hit a triple or a home run, like I'm just gonna put it in my back pocket and look like a genius. But was I a genius? Probably not. So it's because I continued to invest throughout different market cycles that and I could remain patient and I could take advantage of timing, right? Because I have cash flow coming in, because I have my reserves in place, every once in a while you get that black swan. And black swan's probably not the right word, okay, but like that zebra type investment. It's not a horse, okay, looks different, smells different, okay, feels different. You're just like, you can get 100% behind it and you can take a little bit of risk there if that's in your profile. um but anyways, yeah, so boring. I love boring. Give me boring all day long. Somebody else said, I like boring too. Pick dot fund notes and bonds. Ooh, yeah, definitely. Um, I would love to know more about which bonds you're in, because I think that's a question we get quite often. People are like, hey, like if I am in stocks, bonds, and mutual funds, what bond funds do you like? What are your favorite tier one, very liquid investments to beat inflation? Well, that is the question. Tier one investing, thank you so much for asking that. Tier one investing isn't meant to beat inflation. Okay, that protection, that liquidity, or reserve piece, it is not meant to beat inflation. It's meant to keep up as much as possible with inflation. Okay. It's meant to access capital quickly for opportunities or emergencies. That's it. Okay. So, I have a little bit sitting in cash in a high yield savings account. Okay. It's probably earning 3.5, 3.6%. Then I have another couple months in money market funds that I can get at pretty quickly. So the month or two that I have like in the bank, I can get at that like instantly. Okay, the funds that I can have sitting in my money market, probably another couple months. That it takes me like 2 or 3 days to settle out. I mean, like a day to sell. Okay, like if I have to sell on a Friday, it's going to take me to the following Monday. So it could be like up to a week to settle those funds. Um, you know, money market accounts, I'm probably looking at 4%. Okay, nothing earth-shattering, but it is a little nudge, right? And I have my money outside the bank. Okay, I'm comfortable with that. Um, Cash flow life insurance. I mean, a lot of people use tips, okay, T-bills, stuff like that. They build out those type of ladders. I tend to push those more to income because they can take a little bit longer to settle. Meaning like when you actually have to get the funds back, it can take like a week or 2 weeks sometimes to get those funds back, depending on how you invested. Cash flow life insurance. I do not suggest that as an investment, but as a way to build your own bank outside of the banking system. Okay, but I can actually access that cash as well. So those are kind of some of my favorite ones. But again, that tier one's not meant to beat inflation. It's meant to kind of keep up. Okay, as much as possible. Okay, limit erosion. It's the tier two, the income and optionality. That's where we're trying to beat inflation. Okay, like really trying to like, earn a little bit of income for sure there, but keep our money liquid. How do you balance the long-term compounding growth in these type of investments with real life needs of trying to do basic stuff for your own family, like upgrading a roof on your home? Do you basically have two different mental accounts that you're using, one for your personal basic capex and one for your long-term retirement growth? Um, yeah, there's several different ways that you can arrange your finances. I mean, you could, you know, I'm just trying to like think through in my head. If it were me and I were looking at, say, like I needed 10K for a roof and I'm gonna need that in like less than 3 months, I would probably keep that extremely liquid and safe. I would keep it in like, you know, money market account, cash in the bank, or a cash flow life insurance policy. I would even take that. And the reason why I leverage that piece for those type of things is because I can take a loan and then I can pay off the loan from my investments that are actually earning more. So I can shove that 10K up into the income producing or maybe even up into the growth, depending on how my portfolio is balanced out right now, but I can shove it up into a higher tier, use those returns to pay off the loan. But if you don't have that in place, you don't need to have it in place. Okay. I'm just saying that that isn't a way to structure it. Otherwise, if you have things that you have to pay for, like in say 3 months or less, keep it super liquid. Okay. If you need to get at it and say like in under a year, you know, push it up into a money market. Okay. Um, uh, Even like debt funds, you can, say like you don't need the 100K for like a year, you could maybe invest that 100K into very well underwritten conservative debt funds. I'm biased about ours. Just going to tell you, I have used it for 5 years to put money in and out, in and out, in and out, and I love it. It works, but don't go swinging for the fences and try to get the highest return out of that money. Keep it super, super, super safe. Okay. Past that, you might, look at, other type of investment assets, a little bit higher tier two. We've talked about promissory notes, yield funds, stuff like that. Those things, sometimes have a longer 24 to 36 month longer time period. But just keep it, if you need the money, keep it liquid, keep it protected. I actually had one investor client that I work with personally. She was going to buy a piece of property herself, and she invested it in Tesla last November, and then come February, her stock collapsed. Um, Now she doesn't have a didn't have the down payment for the property anymore. So we don't want to go betting the house with it, putting it into that growth and equity space because it's volatile. We need to be able to hold that tier three. We need to be able to hold for 5, 7, 10 years. We don't want to be in a position where we have to liquidate those positions. What's more exciting than getting expert advice about increasing your your wealth and net worth? Hey, thank you for joining. There was a period of time that was skipped in your previous chart, 2016 and 2020, I think. Can you walk through each period and what investor actions would make sense during each time period? Um, well, okay, so in 2016 and 2020, that's largely going to be your value add strategy. That's kind of like when they really, really were taking off. Money was cheap. right? Um, More importantly, the point of that table was to show you what the market was giving you to invest in. Okay, so what was happening in the market and what was the asset that the market was kind of handing over to you as a way to create money and growth. Now, here's the thing, income producing assets like our tier one, tier two, um, if tier one, you have to have. Tier two, you need to build. Okay. If you're in a market cycle where you can build tier three assets and harvest some of the cash flow and put it into tier two assets, and then take some of that cash flow that you're getting from tier two assets, either allow it to compound or move it back into tier three and grow both tiers at the same time, cool. It also depends on where you are at in your investing. Okay, so if you are closer to retirement, I would say this income and optionality, right? Like build that out as quickly as possible. Take as much active income you can off the table, shove it into this. This is what I would do if it were me. I would put it into this tier two. That way you have your cash flow taken care of. You may not need it right now, but you can allow it to compound and continue to get an equity-like growth without taking the equity risk. And okay, if you're further away from retirement, then maybe balanced allocation between tier two and tier three, right? So we want to look at what the market's handing us, but we also need to look at what our portfolio needs. And I would say we actually need to look at what our portfolio needs first, and then look at what the market's giving us. Back to the bond thing. This investor invests primarily in municipal bonds where they live. Okay. Oh, to kind of sidestep being taxed on the federal or state level. Yeah, muni bonds are fantastic. Um, there are funds that carry municipal bonds in them. So, if you need a little bit more liquidity. But yeah, there's all the different types of, investments. I'm just partial to the real estate because I can get greater control and visibility of it for sure. All right, guys. What other questions do you have? And as always, engaging conversation. I love it. If I will stick around for like another minute. If you guys have additional questions that you want to ask or comments that you want me to kind of like address. Otherwise, I will see you next week. And thank you so much for investing your time, not only here with me, but also in yourself. Take care.